Well, good evening, all. Ira Epstein, and here we are with your financial market wrap-up. And this wrap-up is for the evening of Wednesday, the 22nd of March, 2023, getting on to 6:25 p.m. Central Time. So I was right. I stuck my neck out here a bunch of times, said I'm going with a 25-point hike. That made all the sense in the world, and that's what the Fed went with. The Fed changed some words. They might do some more hikes. They definitely clarified. I mean, they've done it every time. The Fed chair did an excellent job today, by the way. He said, our mandate, and we're going after it, we have to drive inflation to 2%. And that's their goal. They have two mandates. They went into the labor mandate, and he made it clear that the labor market is tight. It's unusually tight, especially for the service sector jobs, the people that want to work, be it hotels, restaurants. Remember, we're North America. We're going to be in the spring and the warm weather very shortly in much of the country. All the outdoor facilities are going to open and jobs are going to stay tight. He said what I've been writing about. Wage pressure on those jobs has definitely abated. That doesn't mean they're dropping. They've abated. Shelter prices have fallen. Leases have come down in a big way. So they're making big headway on the general inflation of the economy, but not on the labor part of it. With that, he said that they're going the quarter-point hike. He gave every indication they're going another quarter-point hike in May, but they're going to stay data-dependent. So an indication doesn't mean anything. He did his best to say that he believes that the banking system is solid and that deposits had been not taken away from people. They had access, they had their money. He almost made it sound like people were going to keep getting that. Miss Yellen came out after he was through talking, and she's got another day tomorrow on Capitol Hill, by the way, and she made it very clear that no, the Treasury is not considering blanket raising of the FDIC number and covering everybody's money. Absolutely not. She was very clear about it. It tanked the market because it puts these weak banks right back where they were. The problem with the weak banks, and I want to give you food for thought, consistent in today's speech was Mr. Powell saying that he expects the banks are going to tighten their standards. They, the Fed, the FDIC, the Treasury, they're all going to look at what happened to these banks that have failed, and there will be some rule changes. But he kept saying he expects bank standards to continue to tighten, the equivalent of another rate hike. So it got me thinking right away, where's the next shoe? It's commercial real estate. Cities that are full of these buildings, office buildings that aren't doing anything. That's got to be the next shoe. And what happens is a lot of these start coming due now forward through the rest of the year, the loans. Well, when you get to those loans, what happens? The value of that property cannot be what it was just 3 years ago, 4 years ago. I don't know when the loans were generated. It's probably down via the pandemic and never really did come back. I mean, I can shoot, I hate to say it, if you have a shotgun, you can shoot all over downtown Chicago at some of these buildings. There's nobody in them. I certainly would never do that, but you get my point. The stores underneath where they have the retail space, that every space was taken, there's plenty for rent. So we haven't seen that, and I'm fearful that that's going to be the next shoe that drops. Now, the stock market's going to do its usual. It's going to look at this the other way. The stock market is going to say to you, the Fed might have one more interest rate in it after this one, then they'll probably pause. They'll count on the banking to get tight enough to keep that, which means I got a free ride in the stocks that I like. That's how they're going to interpret it. They've done it each and every time. I have no reason to think they won't do it this time and come up with whatever reason they want. So that's where we're at. Tomorrow we get two more banks coming out. We get the Swiss National Bank, the Bank of England. I expect at least a 0.5 point hike out of the Swiss National Bank to match the ECB and a 1/4 point at the Bank of England. They're being pulled along, but their inflation numbers that came out today were absolutely horrific. They just keep growing and they shouldn't be. So if we could, let's go to the chart action. In the S&P, if you rally, the resistance should be the 39 89 level. You can see the 18-day average of closes. When you look at the chart action here, you can see how the market's trying to work its way down, but the pattern is not that way. You have higher lows and higher highs. That's friendly. The battleground's right where we talked about. I feel good about that. When we were over here, I said, I think you'll have trouble between the 18, the 200 in gray, and the 100-day average. And yes, that's where the market is having the problem at this point. Do I tell traders to ever buy, by the way, into that? No, I tell them to wait, let's see what happens. The Bollinger Bands are fairly far away. They're not in play, and you're not overbought. You have momentum that is flattened out. So at this point, I'm still going to say I don't know what to do with it because prices under the 18-day average gives me a bearish bias. The swing line is up, which is bullish. They fight each other, and I walk away. When you come into the NASDAQ, you are very overbought, not trying to embed. You've hit the Bollinger Band a bunch of times. You could easily see profit taking in this index. If it does so, you've opened the door for 12,405. But the key is, how does it, if it breaks? It's right now 12,722. You've got to get under 12,525 to say that you're actually weakening this market. I don't like when markets are overbought, so I tell my traders, nah, you don't put new money into an overbought market. The rally in the Dow was a bear market rally into the 18-day average of closes that failed. Why a bear market? Because you've been consistent in staying under the 18-day average, so the bias is down. And when you get the swing line turning up, it's a bear market rally because of the bias. When we come to the Russell, same thing. We've tried a rally, but it doesn't get any traction, in fact. You're not staying embedded. And you had a bearish crossover where the 18-day average is now under the 200. This market has opened its door again, I think, for the 1681 level. It's not trending, however. You have a higher high and a lower low. In the T-bond market, you are overbought, drifting. The market's trying to get the 18-day average now over the 200. You can see that. So that would give it some upside bias. So why is this getting a bid? Just what I said. I think the market suspects the Fed is at the end of these hikes. Number two, the banks are going to tighten standards. Number three, the economy is going to slow down. So all that together is not bearish, the long end of this market. If anything, it offers some friendliness to it. Think it through, and I think you'll agree with me. In the 5-year note, that's the same type of argument. You know, the market's now caught with the bias. You've got it up. It's not trending. You have a higher high, lower low. But it, too, is saying to itself, okay, the Fed says the economy is going to slow down. A slowing down, maybe the Fed doesn't have to go more than one more hike. Maybe it doesn't do that one. It could use the excuse, hey, the economy slowed because the banks have tightened the standards, and you're not putting the pressure on this market either. The dollar should accept this all as bearish news. Nothing that they're giving you is a prop for the dollar. Doesn't look like a lot more interest rate hikes are on the horizon, immediately at least. Number two, the economy's weakening. Number three, we have a big banking problem that I think is going to get worse. So you get good rallies. I think the pros are going to sell that. And at the same time, I think they're going to get more bullish on the euro, the Swissy. Those currencies look to me now interesting all of a sudden. Higher rates, economies that are not weakening like us. Certainly Switzerland has its own banking problem, and I'm not the biggest fan of one large bank. What do they do if that thing gets in trouble? But it's the way it is. So that's where you're at with that. In the British pound, I think you'll see that they will continue to raise this interest rate, but they're going to talk as though it's the last one, and that their economy's doing better, that this blip in inflation, that's what I expect the bank to say, that they're disappointed with it, but they need to see, is it really headed up or not? It came from food and beverage. In other words, people drinking their minds out. It's the way it is. All right. In Bitcoin, settling back. Remember, this was a safe haven play. So now you don't need the safe haven. We don't know that there's other bank issues just yet. It got very quiet. I think you'd agree with me on that. You're hearing PacWest has a problem. We'll see what First Republic can do with raising more money. But I think First Republic has to be sold. That's my own opinion. I think there's big problems. And I think the vultures are going to swarm it very soon to see what they can do. This idea of just keep putting in money for deposits, 120 days to rescue the bank, doesn't sound right to me, hasn't sounded right. Then we take a look at the energy markets, and they might be saying to themselves, okay, maybe that headwind of the dollar is going to disappear a little bit, so we get a little bit of a bid coming in right here. We also hear Russia's going to stop now putting out oil to the tune of 500,000 barrels a day to get down to what they said, less supply. So you're getting your little bit of a bid. I like the action in gasoline. Remember, I think the spring-summer numbers are going to kick the market right on up from here. And in that gas, it's a hard time of the year. I mentioned it yesterday. You're not that cold, you're not hot, and you're in a big, broad sideways swath on this market. So I'm going to be talking about in the morning something important. We get the yin-yang effect. What is that? We have our Fed announcement at 1:30. We get the press conference. Today it ended about 2:15, 2:20. Ms. Yellen was speaking. Her action moved the market. And during that, Asia's closed. They're sleeping. Think of the time difference. Europe, how many hours are they ahead of us? So at that time, they're all gone from their offices. And I know you all think that people are sitting there trading 24 hours a day, big volume. Not so. Evening volume, once it dies off, it dies off. Yes, it trades, but not the volume you think. Very light. But trading, tradable, but light. You have to adjust your trading style if you trade in the evening. That's what will happen. Then as Asia and Europe come in, how do we react to it in the morning? I call it the yin-yang for a reason. We go one way, sometimes they go the other, and we have to join them in the morning. I'm going to cover it. I'm going to start recording at 5:15 in the morning. My videos will be ready. I want you to join me. How do you do it? You move your cursor up to the top here. Go to the free offers, Ira's free trial. If you haven't done this before, I want you to join. Do it tonight, and I'll try to get you into it so you get to getting the video in the morning. I'm Ira. You have yourself a good day. I will talk to you tomorrow.